Focus on Ports, brought to you by Transnet National Ports Authority.
Hello and welcome to Focus on Ports. I'm Alicia Second. Well, natural resources is one of Africa's major developing industries positioned to drive the continent towards prosperity. About 1/5 of South Africa's economy can be attributed to the mining sector. Hindrances such as poor infrastructure and a lack of skills may dampen investor ambitions though, but the demand is certainly increasing. Dry bulk accounts for over 50% of volume of Transnet's rail and ports, and keeping up with the market demand, Transnet National Ports Authority has a number of plans to accommodate this flourishing industry. Joining me in studio now to discuss the sector as well as their dry bulk strategy from TNPA is Nico Walters. He's a General Manager for Strategy, and from our Cape Town Bureau, Peter Major, Mining Consultant at Cadiz Corporate Solutions as well. Gentlemen, thank you so much for joining me today. And Nico, let's perhaps start off with you here in Johannesburg. I've been reading that the words market demand strategy have firmly embedded themselves into the Transnet lexicon. What exactly are we looking at here? What's the plan that's being laid out?
The market demand strategy, Alicia, is exactly what the word says. It's based on what we anticipate investing, based on what the market is telling us what the requirement for volumes will be into the future. So when you look at Transnet, the whole investment that we anticipate spending over the next 7 years is around 300 billion rand. And of that amount, the investment by the National Ports Authority will be about 57 billion rand. And that investment is spread across all the different sectors of cargo that we handle in the ports: containers, bulk, liquid bulk, break bulk, the automotive industry. And what we need to, I think, say is that that will go a long way to address what we anticipate the increased volume demand will be across the port system.
Of course, as you look forward, you look back as well. So talk us through the figures you've tabled when it comes to the impact lack of infrastructure has had on the economy and the mining industry specifically.
Look, what we do in the port sector is obviously to create port terminals that have the necessary capacity to import and export volumes. So when you look at the bulk sector, we should look at the total chain, which obviously starts at the mine via road or rail coming into the port. Where we're currently sitting in terms of our dry bulk capacity is that we do have capacity in the Port of Richards Bay for coal exports, over and above the roughly 76 million tonnes that we anticipate to get this year. We do have capacity at the Port of Saldanha, where we export the iron ore from Sishen Saldanha. And then in the other ports, we are in the process of creating capacity. In Port Elizabeth, we're running short in terms of manganese capacity, and that facility will be replaced by a new facility in the Port of Kuga. So at this point in time, from a port perspective, we almost at the point where we're starting to make decisions as to how to invest to create more capacity. But the problem that you will obviously have is that if we don't create that capacity, you will find bottlenecks in the system, and hence the mines will not be able to export.
Yeah. Peter, of course, so you've got your eye and your hand, I should say, on the pulse of the mining industry at large here in South Africa. I mean, take us through from what you've been monitoring, the kind of impact lack of infrastructural support in this regard has had on the mining industry and the kind of growth potential we could be hitting.
Well, interestingly, we're seeing most of the trouble in the mining sector on the precious metals front, primarily diamonds and gold. And yet, those are the sectors that aren't really impacted on Transnet. They don't really need port facilities. They don't even really need a railroad. Where we need the railroads and the port facilities are on our bulks. And the iron ore side has definitely been constrained. The manganese side has definitely been constrained. And I think the chrome side has been constrained. Now, coal, as Nico pointed out, if we do 76 million tons this year, I think that's going to be a record. I don't think we've ever done over 70 million tons in any year ever. And we've been averaging about 64, 65 million tons the last 10 years. And everybody complained we missed the run on coal, and we pretty much did. Because coal prices were up to $150 plus out of Richards Bay. And here we could barely get 62, 63 million tons out. But that was more the railage problem than the port itself. I think Richards Bay Port has always been able to handle more than we could get out. And now that they've taken the capacity to a theoretical 91, I just can't see us ever doing 91, not even in the next 10 years. But Sishin has been a constraint, and Port Elizabeth has been a constraint. So we've really missed out on the amazing prices of the last 6-7 years, the iron ore, the manganese, and even the chrome price, because of port constraints and rail constraints.
So talk us through then, Nico, from the National Ports Authority side of things, just how you're looking at asset utilization here. Is there a focus on some ports more so than others?
The ports are created to create capacity for specific chains. And when you look at the ports that we're talking about now, you'll find that if you look at Richards Bay, that's primarily a coal export facility, which makes up well above 50% of the volumes even through that port. It's closer to probably 70 or 80% of the port's volumes. When you look at Saldanha, you'll find that when you look at bulk cargoes, they don't really go to a multitude of ports. They try to settle on one specific export chain and they build and expand on that chain. So when we look at things from a Port Authority perspective, the indicators that we check is obviously volume, because volume drives capacity at the ports. But the other important aspects that we look at is the utilization, as you pointed out, of the assets in the port. And to do that, as the landlord Port Authority, we have a two-pronged role. The one is to look at the terminal operators to make sure that they efficiently utilize the land and the facilities that they lease from the National Ports Authority. And the second focus that we have is more an infrastructure provision focus, where we measure the utilization and the occupancy of the existing berths in the port. Because what the viewers must understand is that when that utilization reaches a certain point, what happens in the chain is that the chain starts to become congested and you get vessels waiting outside, or you get volumes that cannot get into the port quickly enough to feed the vessels. So from a Port Authority perspective, those are really the two key things that we focus on to make sure that they stay within certain parameters. And those parameters are normally determined by the number of berths, the volumes, and obviously the size of vessels that call in the port.
Peter, when it comes to the study that we've had the Transnet National Ports Authority do, they've certainly highlighted that their focus is going to be on coal, iron ore and manganese exports specifically. Warranted in your books, given the supply-demand dynamic that we're currently looking at in play within those three spaces in the commodity sector?
Boy, this is where it gets tricky, Alicia. Because as we see at Richards Bay Coal Terminal, here all the money's been spent, all the work's been done, taking that terminal up to 91, and yet we haven't been able to use its original 72 million tons ever. And I think it's theoretically been at 72 million tons. You correct me, Nico. 71 million ton capacity for what, 20 years? And I know sometimes 10, 12, 15 years ago, we'd get up to 68, 69, 70. But the last 10 years, here we average 65. Now we've taken this magnificent terminal up to 91. And if we can't get the railage in order, or if the coal price is quite low and the miners say it's uneconomic to transport, to export, then you sit with this overcapacity and you say, gee, we spent all that money, it could have been better spent elsewhere. This is the hard balance we're always trying to do.
Absolutely.
If I look forward at commodity prices, coal is so cheap relative to oil. I don't think it's ever been cheaper, certainly not in 20, 30 years. So I've got to believe current coal prices can't go much lower, and so we should be able to export a lot more coal in the next 5, 10, 15 years, because India is building all these plants all along the country. They really need it. China's coal imports keep going up. On the iron ore side, I'm a little more worried because there's some massive developments going up and down the coast of Africa, West Africa. And if even a third of those big developments come in as planned, I think there's going to be a bit of abundance of iron ore, which means the price could fall. And then we might not be able to get up to 60, 70 million tons through Saldanha. It might just be uneconomic. You know, the mines may say after 45, 50, we can't justify. So that is a risk. I think coal prices are low, so we'll export more. I think manganese prices are low, so we can export more. So PE, we will utilize that port, I believe. It's just the iron ore side, I'm kind of 50-50. But there's always that risk, And it is better to have a little overcapacity than to have undercapacity.
Where the cynicism comes through from, though, Nico, and you can understand it, is that it's born out of the trend of setting out lofty targets and then lack of follow-through, so implementation at the end of the day, of those blueprints that have been laid out. So what's being done to ensure the 7-year, 300 billion rand infrastructure investment plan isn't a plan that just stays on paper? Because something that Peter has alluded to is that a stronger focus has to be placed on integration within this plan between the various transport links.
If Alicia, if you consider what TNPA sets out from a strategic perspective, one of the things that we focus on is to create a port system that does just that. That is an integrated system linking that to either road and rail traffic to make sure that commodities into the port follow an efficient as possible route. What we do to make sure that volumes materialize is to check with obviously the mines, because we need to understand in terms of their production and export capacity what they anticipate exporting. And it is based on all of these discussions that we've had that we have come up with the volume targets that you currently see when you look at the volumes that we're forecasting. Now, these things we do not leave like that and just think about them again in a few years' time. So what we do on an annual basis is we work very close with all of the stakeholders involved, and we make sure that if there are slight delays in maybe export capacity or maybe in any of the projects that we might be busy with, that we talk to one another to make sure that that capacity is put on the ground. I think what is also important to understand is that port capacity, and I think Peter sort of is alluding to that in terms of the comment he made with regards to additional capacity on the ground. Any of the expansions that we're looking at now will follow roughly a 2 to 3 year process. So for the Port Authority, it's a matter of we have to go through all our studies now, we have to work and constantly update the volumes that we are anticipating, and we have to try our best to get that volume in place, like we say, ahead of demand. And that is what we've been almost lucky to do up to now. The capacity that Peter referred to, on the iron ore side, we estimate around 61 million tons of capacity through the port. We might get, if we're lucky, I think about 58 million tons this year. The coal is one of those things where we're all hoping that we'll get 76, 77, but the existing capacity is, like Peter has alluded to, it's about between 91 and 95. So there is still a lot of capacity there.
Lots of capacity. I just want to, get your view. I mean, you say you have conversations with key players within the mining industry. You've got the global economic crisis to an extent having weighed on demand. You've got local issues impacting supply right now. But the kind of investments that you're making, the capital investments that we're seeing, implies that you're pretty optimistic. So too are the players on the ground about the growth outlook and that potential moving forward, the commodity story moving forward.
Yeah. Look, we remain always obviously positive about the country and what can happen in the country, but it is all something that we need to keep a close eye on. I think we've seen in the past with the bit of an economic dip we had previously that volumes dropped significantly, but what has happened is that the volumes have actually picked up, I think, quicker than we anticipated, although they might not be at the levels where we would like to see them. And volumes are obviously the one big driving force that influences what we put on the ground. If we don't have the volumes, then the ports and the rail and the road, for that matter, will not be able to provide the ports with sufficient cargo.
Peter, before we wrap this part of the conversation up, a very quick comment from your side. At this stage, 13 minutes into the conversation, are you convinced?
Yeah, I give our port people a little more credit than I do our mining people. Because the port people have the firepower. They have the budget in the government to get this. I think they were a little slow in implementing improvements to the rail side during this commodity boom, but I think now they've got the momentum, they've got the drive, and they got the budget. My concern is our mining industry has lost such control over costs that instead of us being the lowest cost producer in the world or in the lowest quartile, I worry that we're just more or less in the middle on a lot of our bulks. And so it's up to the mining industry to get their act together. They must make sure that they get their costs on the mine down in the lower quartile and keep it there. So if we have a commodity slump, we will still be as keen to export every ton that we can mine because we'll still make a profit. So it's not just Transnet, it is the mining companies that have to do their part. And they have more catch up now, I think, than Transnet.
Well, we're heading into a quick commercial break. When we come back, we'll be continuing our discussion on Africa's mining industry, and we take a look at the kind of budgets that are involved. How's this all going to